consolidation. Steps involved in consolidation. Let us go in a conceptual and a detailed manner. So how each and every step has to be dealt for. Therefore, let's go. Steps involved in consolidation. So please make it very important. So if you don't understand these steps, my dear friends, so when we go for problems, there you will, I'm damn sure you will struggle. So one-on-one, if you don't understand, you can ask me, we can stop and you can ask. Yeah, so let's go in a pace. Let's start. Steps for consolidation. What is that? Steps for consolidation. Usually commonly we are going to use these steps for all category. So steps for consolidation. Steps for what? Consolidation. Very good, you are all. Now, let us go in first step 1. Step 1. Step 1 is called as Pramod. It is, step 1 it is called as date of control. Date of what? Date of control. Step 1. Just date alone you have to mention. Clear? Date alone you have to mention. So here what you have to, date of control means?
The date on which you acquired.
The date when more than 50% shares are acquired. Are you understanding? The date when more than 50% of shares are acquired, that time what we call it as date of control. Next, step 2. Sir, this is one step, yes. So why this step is important? Because we discussed 3 category of problems. Control is acquired beginning the period, during the period, and multiple acquisition.
Multiple.
Yes, sir. Correct. So for that purpose, the date of control is very important or not?
Yes, sir.
So based on that only, I have to split up to the date of control. It is a pre. After the date of control is post. Correct. So pre-acquisition profits are capital profits. So post-acquisition profits are revenue profits or not?
Yes, sir.
Yeah. So because here also, Pramod, since already financial instruments is over, suppose if you have investment in equity instrument of other entity, it is called as financial asset.
Yes, sir.
Yeah. So therefore, here, suppose if I have a subsidiary is nothing but a financial asset. Subsidiary, associate, joint venture is nothing but it is a financial assets. Got it?
Okay.
Now,
Yes, sir.
whatever the investment is expected expectation of return. So therefore, after acquisition, if you expect the return, means it's a revenue profit. So before acquisition, it's a capital profit. Got it? Yeah. Step 2. Step 2. Shareholding pattern. Shareholding what? Pattern. Shareholding pattern. So here, including bonus issue. Bonus issue, if any. Because of bonus issue, your percentage of holding will not alter. Got it? Everyone will get, no existing shareholders, everyone will get bonus. Therefore, it will not alter. Got it? Slowly.
Yes,
yeah.
sir.
So now, sir, what is shareholding pattern? It is nothing but, my dear friends, holding company. What is the percentage of holding company? So what is the shareholding percent? Example, if it is 80%, correct? 80%. So what is outsiders? Outsiders, how much balance in figure?
20%.
Correct. This outsiders, what technically we call it as non-controlling interest. Non-controlling interest. Earlier in old syllabus, we used to call it as minority. Minority interest. Are you understanding? In old syllabus. Yeah, but now it is not required. You have to call it here in after what? Non-controlling interest. Clear?
Yes, sir.
Yeah, this holding company, what we call it as controlling interest. Controlling interest. This is how I started my chart. If you are not wrong. Yeah. So look out. This is how I started my chart. So here itself, I have mentioned in this chart control interest. Correct?
Yes.
So X Limited, if they had the controlling interest, then only it's a subsidiary. So mine is controlling, means others are non-controlling interest. Outsiders are called as non-controlling. Are you understanding?
Yes, sir.
So this in a first session, what we discussed in introduction to consolidation, we had this information. Yeah. So now, so here either this 80%, if they have given in a problem, we will take. Otherwise, number of shares held by the holding company divided by total number of shares or not, or how it will be calculated? Number of
Yes, sir.
shares held divided by
Number of total shares.
total number of shares into 100. You will get this percentage or not? Correct?
Yes, sir.
Yeah. So after this, write the note. Note percentage of holding is to be checked on date of consolidation. On date of what?
Consolidation.
Consolidation. So that means suppose you acquired beginning of the year, but consolidation you are doing at the year end. Usually at the reporting date you are doing a consolidation. So if you are doing at the reporting date, means that day on the date of consolidation, how much is the percentage of holding company and outsiders, you have to check. Correct? Sir, why you are saying like this? Because here only multiple acquisition also will come or not? Because when company was acquired, other company subsidiary, when you have acquired, you would have acquired 60%, but on the date of consolidation another 20% you would have acquired. That means will you consolidate for your share is 80% or 60%?
80%.
80%. Therefore on the date of consolidation you have to check what is the percentage of holding, shareholding pattern. Got it?
Yes, sir.
Next, let's go to the step number 3. Step number 3, so from here in after it's a very very important. Step number 3, it is analysis of profits of subsidiary. Yeah. So touch your heart and say, in whose book consolidation is applicable?
Holding company.
Holding company. That means in a holding company, your financial statements is already ready. That means whose financial statement you have to analyze? Whose financial statement you have to add?
Subsidiary.
Subsidiary. Correct? So in a previous 2 steps, I have not checked any financial statements of subsidiary company. Just I said this is my percentage of holding. Balance is outsiders. Correct?
Yes,
Yeah.
yes, sir.
Now only I will take subsidiary company financial statement, and I'm going to, because since I have made the investment, purely it is for profit or not. Out of that
Yes,
my
sir.
investment, I will expect the profit or not.
Yes, sir.
Yes,
Correct?
sir.
So therefore now I will take the subsidiary company financial statement and I will analyze. So each reserves and surplus I will analyze, and I will check if it is up to the date of acquisition. If the reserves are there, it's a pre-acquisition. Therefore, it's a capital profit. Correct? Yeah. If it is post-acquisition, it's a revenue profit. Clear?
Yes, sir.
Yeah. Sir, analysis of profits of subsidiary. That means here what you are going to do. Correct? It is nothing but so analyzing pre and post acquisition profit as capital profit or revenue profit. Revenue profit. Are you understanding? In each category, what I'm going to do?
Analyzing pre and
So
post.
profits of subsidiary company financial statements I will take, and that I'm going to analyze whether it's a pre-acquisition profit or post-acquisition profit. Got it?
Yes, sir.
Yeah. Now, so first one, let us go. First one is, my dear friends, A. First one, A is general reserve. General reserve. That is what? Accumulated profit. Accumulated profit. So suppose if securities premium it is a complete, it's a capital profit, like that we will take. So it depends on the problem. So here, so first general reserve, suppose accumulated previous year profits are there, that we will take. So in that general reserve, my dear friends, so we will take what is general reserve profit is given. Correct? So this I will go into 2 category. Yeah. So it is pre, post. Are you understanding? Suppose if it is control is acquired on control is acquired on 1 4 1 4 20 1 4 20, that means it is 1 4 20. So it is what we call it as beginning. Post means this is current year. Are you understanding? So financial year is what? 31st March 21. This is date of consolidation. So suppose if you are preparing consolidation in 31st March 21, then this is opening pre-acquisition was on that day out of general reserve. How much was the opening balance? That is completely pre. Completely what? Pre. So after acquisition, so how much closing balance, opening balance and closing balance we will compare. So suppose 2 lakh is there. Example 2 lakh. Example is 2 lakh. Pre on the date of acquisition, so I had 50,000. So or let us make 1,50,000 opening balance was there. That means current year how much? Current year how much is increased?
50,000.
50,000 is current year. Correct? Suppose if the control is acquired during the period, for example, during the period means, for example, here let us make 1720. That means after 3 months. Yeah, in
Yes.
that case only. So here out of current year also pre 3 month, post 9 month I will do. Got it? Yeah. So 12,500, 37,500. In this case, these two are called as completely pre. This only is post. Got it?
Okay.
Yeah. So this is what the difference between control if it is acquired beginning of the year means this partition, that is current year partition, will not come. Clear? If control is acquired during the period means already on opening balance what was there completely it's a pre. Then out of current year profit also up to the date of acquisition it's a pre or not?
Yes, sir.
Yeah. After that it is a post. Like this it will come. So this is control is if it is a during the period. Control is during the period. If it is there, sub classification will come. So this total 1,62,500 is capital profit. Is capital profit. This is called as revenue reserve because this is general reserve. Correct? So since it is a reserve name, I call it as revenue reserve. Got it? Capital profit. This is called as what? Revenue reserve.
Revenue profit.
Yeah, it's a revenue profit only. General reserve and P&L is a revenue profit, but general reserve is suppose separate account, P&L is separate account is there. General reserve apportionment, what we call it as revenue reserve. P&L is called as revenue profit. Got it?
Okay.
Both
Yes,
are
sir.
revenue only. So general reserve and P&L both are what? Revenue profits only. But general reserve is called as revenue reserve. P&L is called as revenue profit. Got it?
Yes, sir.
Yeah. So that's how it will work, my difference. That's how I do. So now this is one for one category I have shown here. Next, second one, what you have to do, my dear friends. Second, on the date of acquisition, suppose if there is any revaluation of assets is there, you have to check. Revaluation surplus. Revaluation profit. Revaluation of PPE. If any, if it is there, you have to check for revaluation of PPE. So that revaluation of PPE. Correct? Revaluation of PPE. So whenever is there revaluation of PPE, my difference. So here what you have to do? Revaluation of PPE. So here that profit, revaluation profit. So this is always capital profit. Capital profit. Are you understanding?
Yes,
Yeah.
sir.
Then on account of revaluation, there will be additional depreciation or not? Additional depreciation. Additional depreciation on account of revaluation. On account of what? Revaluation. So this you have to do. So revaluation profit, first you have to compute, that is on the date of acquisition, what is the book value, carrying value, what is the revaluation profit formula? Revalued amount minus carrying amount of PPE. Carrying amount of PPE is a revaluation profit, which is completely capital profit. So additional depreciation, how it will come? Additional depreciation, how it will come? Yeah. So depreciation on revalued PPE, depreciation on revalued PPE less depreciation on carrying amount on date of acquisition. So what you get is called as additional depreciation.
Yes, sir.
Correct? That is on a revalued PPE, what depreciation you calculate minus depreciation on carrying amount on the date of acquisition. You get what? Additional
But sir,
depreciation.
there is also impairment, na?
Yeah.
Always the value is not up. There is impairment is also there.
I said here revaluation profit. So here suppose loss is there. Yeah. So that profit includes loss also, no? Negative profit.
Yes, sir.
Correct? No. Here additional depreciation. Suppose if there is a savings, if value is reduced means so depreciation is lost. Correct?
Yes, sir.
So depreciation is loss. In that case, there is a tax benefit. Tax benefit was lost or not?
Yes, sir.
Correct?
Yes, sir.
So that we have to. That is a, if there is because of revaluation, if it's a loss, there is a additional depreciation which is negative. That we have to adjust it.
Okay.
Got
I
it?
got it.
So additional depreciation, either here it will be plus or minus, both will come. Plus or minus, both will come. Clear?
Yes, sir.
Yeah. So it is capital. If profit is there, capital profit. If loss is there, capital loss. But pre is it's a capital in nature. Post means revenue in nature. Got it? Sir, why you are
Yes, sir.
calculating revaluation? Because this additional depreciation has the impact in my P&L or not? Because just imagine I'm taking subsidiary company's financial statement and I'm adjusting in my books of accounts. That means subsidiary company will not do any adjustment. Will you agree?
Yes, sir.
Yeah. So that means here, if even though that is whatever the revaluation, this all I'm taking, this is in my holding company book. That means subsidiary company would have not charged this depreciation and all. So on the normal book value, he would have charged normal depreciation. So that is in his book. Suppose 1 lakh is the PPE. So 1 lakh is as per carrying amount. But in my book, I said so this 1 lakh is worth for 1,50,000. That is you increased means additional depreciation. You have to charge or not in your consolidation.
Yes, sir.
Correct? So that means subsidiary book, he will not do any adjustment. All adjustments are doing in a holding company books only. That too in a not holding company real asset value. It is a subsidiary companies he is adjusting and adjusting and consolidating. Got it?
Yes, sir.
Yeah. Next, C. C, profit and loss account. Profit and loss account. So here is also what we have to. So same as general reserve. Same as what? General reserve. So here we did or not general reserve treatment. So how much is P&L is there out of that opening? How much? So increase in during how much? Suppose if a control is acquired during the period, then out of current year also we have to do pre-post. Correct?
Yes, sir.
Yeah. So in post acquisition, so we have to do it. Suppose example, if I say, so example, so P&L, whatever balance is there, that P&L is of two types. So one is what? Opening and current year. Correct? In current year, we call it as post. Post, this is pre. Just imagine it is a pre and post. Pre and post. Pre and post. So in post acquisition, so whatever amount is there, so my dear friends, in from general reserve, we can declare what we call in general reserve. From the general reserve, we can declare bonus issue. Na? Yes
Yes,
or
sir.
no? Yeah, we can declare what? Bonus issue. Bonus issue we can, sorry, from general reserve we can declare bonus issue. So from a P&L we can declare dividends.
Yes, sir.
Yes or no? So that adjustments we have to do it, either dividend or whatever it might be. That in a problem specific, let us do it, my dear friends. Yeah, so I don't want to confuse now itself. Just imagine pre and post, keep in mind. So in post, so here adjustments will come, so whatever the balance will come, so here either plus or minus adjustments for minus, so adjustments for revenue items, so plus or minus I will do, so balance what is for this is for balance. So if you get, so this pre-balance, what we call it as capital profit. So this is what we call it as revenue profit. So in P&L we call this as a revenue profit. In a general reserve we call it as revenue reserve. Yeah, in your study material everything they have given as a revenue profit or equity. That's all they have given. Got it? They have not splitted general reserve as a revenue reserve and P&L as a revenue profit. Both they have said as a revenue profit only. Got it? But when they have added in a balance sheet, they have taken separately that portion and they have added in a general reserve and P&L. Got it? That time you should not get doubt. So that's why I'm showing as a split. Next, let's go with item number 4, category D, which is change in fair values, change in or net change in fair value. This is for non-depreciable asset. For what? Non-depreciable assets. Usually for non-depreciable assets. Got it? Sir, what is for depreciable asset? Already we have taken in revaluation or not?
Yes, sir.
Yeah, so that means if it is exposed to revaluation, we would have taken in first part itself. So AS 10 will applicable only, sorry, Ind AS 16 will applicable only for tangible properties, correct? Tangible assets where revaluation is applicable, correct? In the name of
Yes, sir.
revaluation, you have already taken means except those assets, other assets, if there is any change in fair value, that net increase or decrease in fair value, we have to adjust it or not? Correct? So that increase in fair values, this is always, so that is net change in fair value, always this is capital profit. Because this has to be checked on the date of acquisition. So therefore, so what is, so increase in fair value of assets minus increase in fair value of liabilities. Yeah, you will get what? Net increase or decrease in fair value. Got it? If it is a profit, you will distribute to the holding company and subsidiary company, and the non-controlling interest. So you will distribute. If loss is same, so you will distribute. That's it. Got it? Yeah.
Sir, confused between B and D.
B and D na. Array, it's a depreciable asset. Yeah, this is non-depreciable asset. Where is the confusion?
Which one is not depreciable asset? Only land, na?
What about land?
Yes, sir.
What about debtors?
Okay.
What about
Okay.
creditors?
Okay, sir.
On the date of acquisition, there may be revision in fair value, sir.
Yes, sir.
If it is exposed to depreciation, then I will take in the form of revaluation, and on that there may be an impact of additional depreciation, additional or reduction in depreciation. That I will do adjustment in the name of revaluation. Got it?
Yes, sir.
Where depreciation is not applicable, that only fair value changes only we have to account it. Got it?
Okay.
That adjustments I will take for those assets, whatever net fair value changes, that I will adjust in the name of just as a one line adjustment fair value change. Got it?
Yes, sir.
Yeah. So AS Ind AS 16, this and all, we have taken all the standards are over. Thereafter I am taking. Now we are asking which are all not a depreciable asset.
No, sir. I understood this only for land. That's why.
That is in a non-current asset on which depreciable is not applicable.
Yes, sir.
Here I said non-depreciable assets all. Correct?
Yes, sir.
So this is all that is except depreciable asset, all other assets and liabilities where fair value changes is occurred. Clear? On all other assets where change in fair value. Got it?
Yes, sir.
Yeah. Now, in this exercise, my dear friends, in this step 3, what we have achieved? In this step 3, what we have achieved? In subsidiary company financial statements, we have taken and we have analyzed each and every reserves. So whatever is there in a reserves and surplus, each and every type of line item, we have analyzed what is the pre-post, correct?
Yes, sir.
Yeah, if it is a pre-incorporation reserve, pre-acquisition reserve is there, we have classified it as a capital profit. And if it is a post-acquisition, if it is there, in case of only general reserve, we call it as a revenue reserve. In all other cases, it is called as revenue profit, correct?
Yes, sir.
Yeah, so that's what that is. Achievement was in this stage. There is in step number 3, we taken all reserves and surplus of the subsidiary and we have analyzed whether it's a capital profit or revenue profit. Clear? That is CP, RR, revenue reserve, or revenue profit, RP. Got it? That is what
Yes,
we have
sir.
achieved. So that means in this step 3, we have achieved what? Look out the state what I have given here. Analyzing pre and post acquisition profits as a capital profit or revenue profit. Correct? So pre means capital, post means revenue. That's all we analyzed in this problem, in this stage. Got it?
Yes, sir.
Yeah, let's go. So now it is step number 4. Step number 4. Step number 4. Apportionment. Apportionment of profits. Apportionment of profits between holding and non-controlling interest. Between whom? Apportionment of profit. Now we have analyzed each line item. We have analyzed into pre and post. Correct? Yeah.
Yes, sir.
First, let us summarize. So first one we have analyzed general reserve. General reserve. Correct? So what is the category we would have classified? Either it is a capital profit or revenue reserve or revenue profit. Correct?
Yes, sir.
Yeah. So this is what? Revenue reserve. This is revenue profit. So this is capital profit. So pre always capital profit, my difference. Correct? So only in general reserve and P&L, post acquisition, that's a revenue, the portion whatever is there, that only in a general reserve we call it as revenue reserve. In a P&L we call it as revenue profit. But in your study material, so they have not bifurcated, they have used for both revenue only. Got it? So there's a post acquisition profit is revenue. That's the meaning. Now, general reserve. In a general reserve, so if it's a opening balance, I would have taken in a capital profit. If it's a post acquisition means I would have taken in a revenue reserve. Correct? Next.
Yes, sir.
So revaluation, profit or loss. So this is on the date of acquisition we are going to check, not on the date of consolidation. Yeah. So on the date of acquisition, so if it is a revaluation, it's done. It's a purely it's a capital profit, capital profit or loss. Got it? Next, so we will go with P&L. So P&L opening balance, if it is there, it's a capital profit. If it is a post acquisition, if it's there, it's a revenue profit. Are you understanding? Yeah.
Okay. Yes, sir.
Next, so there will be a fair value change or fair value profit or loss. Are you understanding? Yeah. So fair value change. So whether it's a profit or loss, whatever it might be, profit or loss, increase or decrease. So on that day, it is usually it's a capital profit because on the date of acquisition, what is the fair values we have taken? If it is increase in fair values, that's a acquisition date profit. Yeah. So these are that is what are the reserves and surplus you will analyze. Same thing you have to summarize here into capital profit or revenue profit. Got it? Now total. So now, out of this total, now you got what is the total capital profit, total revenue profit, and total revenue reserve. Yeah.
Yes, sir.
Now, so less. So share of non-controlling interest at their percentage. Suppose if 20% is a non-controlling interest, means at a 20%. So on this all 20%, if I remove this 20%, if I remove, balance you will get holding company share or not?
Yes, sir.
Holding company share of profit. Are you understanding? Holding company what?
Share of profit.
Holding company share of profit. Correct? Now, my dear friends. So this, whatever you have written here, non-controlling interest, this total, all this total will go to step number 5. Where it will go?
Step 5.
Step number 5. This, whatever here you have reduced, here, so this will go where? Step number 5. That is a, for, look out, only for holding company it is a pre-acquisition, post-acquisition. Correct?
Yes, sir.
For outsiders, that is a non-controlling interest, that's the shareholders of subsidiary companies who are not holding company, outside shareholders. For them, no pre-acquisition, no post-acquisition. For them, everything is a profits or not.
Yes, sir.
Correct? So that is non-controlling interest. Got it slowly? Yeah.
Yes, sir.
So now, so holding companies, my difference, you should be very careful here. Holding companies pre-acquisition profit, that is whatever capital profit is there. Holding companies, what is this? Holding companies capital profit. Holding companies capital profit will go to step number 6, cost of control. Where it will go? Step number 6, cost of control, COC, cost of control. Cost of what? Control. Correct? So then, so whatever this post acquisition profits are there, like general reserve and post acquisition portion of general reserve and post acquisition profit of P&L, this will go to step number 8, reserves for CBS, consolidated balance sheet. Where it will go? Reserves for
Step.
consolidated balance sheet. Are you understanding slowly?
Yes, sir.
Yeah. So please keep in mind. So in step number 3, what we did, we have taken each and single line item of profits of subsidiary, and we have analyzed into pre and post. Correct? So the result might be, it's a capital profit. Pre means capital profit. Post means it's a revenue. If it is a general reserve, means revenue reserve we call. If it's a P&L, means revenue profit we call. Got it? Then we will
Yes,
summarize
sir.
that capital profit or revenue profit in each reserves. Then we will total. So then out of that, less share in non-controlling interest, share of non-controlling interest. There's a minority interest. So their portion, if I remove, balance is holding company share. Got it? Now,
Yes, sir.
so minority interest, whatever the total is there, that completely will go to completely it will go to step number 5, and holding company's share of profit, it will go to capital profit, will go to cost of control, step number 6, and post acquisition profit will go to consolidated CBS as a revenue profit. Got it? Yeah, this is revenue. Therefore, in a revenue profits, it will go and add. Yeah. So now, so till 4 steps. Do you have any doubts? Slowly.
Sir, is it done for subsidiary only or joint
Everything is
venture?
for subsidiary only. Still now, I have not used anything for holding company. Yeah, I started with step number 3 is analysis of subsidiary. Correct?
Yes, sir.
So whatever subsidiary profits, capital and capital profit and revenue profit I have analyzed, that I have shared in step number 4 to holding and non-controlling interest. Just imagine you are subsidiary. Your profit, holding company has been shared, and outsiders, that is a non-controlling interest, has been shared. Got it?
Yes, sir.
Yeah. Next, let us go to the step number 5.
So suppose they dispose of the holdings and subsidiary before the 31st March, before the reporting period, then they don't have to prepare consolidated statements.
Array, what doubt you are asking, madam? Yeah, you have taken the company, and within 1 year, if it is sold out, means then where is the concept of consolidation? Yeah,
Yes, sir.
for that only you have taken the controlling interest.
No, sir, I'm asking about the first step when you talked about consolidation date.
Yes.
Pertains to that.
Yeah. So you can acquire today. Even after 3 years also you can consolidate. That time on the date of consolidation, what interest is there, that you have to check. Provided if business is aligned. Got it?
Yes, sir.
Step number 5, non-controlling interest. Non-controlling what? Interest.
Interest.
So at its percentage you have to check. So non-controlling interest means what? Outside shareholders are
Yes, sir.
outside shareholders. That's the meaning. Outside shareholders are
Holding company.
array.
Subsidiary company.
No.
Subsidiary
Array,
company.
Pramod, are you in the class or not?
Yes, sir. Yes, sir.
I'm saying consolidation will be done in holding company. That means whose financial statement you have to take and analyze and add.
Subsidiary company.
So that is your subsidiary company's non-controlling interest. You will add again. For you, it is a shareholders of your company.
Yes, sir.
So till now, I have not touched holding company's financial statement. Correct?
Yes, sir.
So here just I have analyzed out of profits, holding companies how much, non-controlling interest how much. That's all. Now I'm going. So outsiders, that's outside shareholders, whatever are there, for them, what is the total value? Yeah. Now let us start. So outside shareholders will get my difference. Number one, first is in equity capital. First is share in. First is share in equity capital. Share in what?
Equity
So
capital.
that is equity shares first. So whatever equity shares are there, equity share capital into 20%. Equity capital, suppose if 20% means 1 lakh is the equity shares are there, means 1 lakh into 20%, 20,000 is the outside non-controlling interest.
Yes, sir.
Then capital profit, revenue reserve, revenue profit. So all these are from step number 4. From where you take?
Step 4.
So have you come across here? Step number 5, what we have written? Share of non-controlling interest, capital profit, revenue reserve, revenue profit.
Yes, sir.
Yeah. So those things I will take because for them there is no concept of pre-post. Clear? So whether it's a share of capital profit, revenue profit, everything is a profit for them. Got it?
Yes,
So
sir.
then I will take, this is the total. This is the total of profit. What that is nothing but capital plus reserves and surplus share. Got it?
Yes, sir.
Yeah. So now out of that, my difference, very important, less unrealized profit. Unrealized less what?
Unrealized.
Unrealized profit. Correct? So unrealized profit. So unrealized profit, that too share of non-controlling interest only in case of upstream. Only in case of what?
Upstream.
Upstream. Now students will get doubt, sir, what is upstream? Correct?
Yes, sir.
What is upstream? Correct? So this is nothing but, my dear friend, suppose if a holding company is there and this is subsidiary. Correct? Yeah.
Yes, sir.
If subsidiary company sold goods, subsidiary company sold means this is called as upstream.
Okay.
Correct? So if holding company has, if holding company sold means, if holding company sold to subsidiary means this is called as downstream. Are you understanding?
Sounds. Yes, sir.
Okay.
Correct? Yeah.
Yes, sir.
Now, sir, why this is? Why this is? That means if it is upstream means who will sold to whom?
The subsidiary sold.
Who will sold to whom?
Sales to
Yeah. Subsidiary
Subsidiary
has
sold.
sold goods to holding.
holding.
Correct?
Yes,
Yes,
sir.
sir.
That means who would have made the profit?
Subsidiary.
Subsidiary.
So profit was made by subsidiary, na?
Yes,
Yes,
Yeah.
sir.
So this subsidiary profit now will be taken by holding company and non-controlling interest or not?
Yes, sir.
Yes, sir.
Correct? So that means that non-controlling interest share only will come here. Holding company's profit will go to step number 8. Are you understanding?
Okay.
Clear? So in upstream, who would have made the profit?
Upstream.
Subsidiary. That means imagine you are analyzing subsidiary. So that means in a subsidiary, they have said, I sold and this is my profit. So imagine 100 rupee worth of stock inventory, they have sold to holding company. Correct? 100 rupees is the cost and it has been sold for 150. That means how much is the profit made? 50 rupees profit made by subsidiary company. Correct?
Yes, sir.
Now, in a subsidiary company P&L, that profit 50 rupees is there. Correct? Now, when
Yes,
that
sir.
profit, when I have consolidated in holding company, so on consolidation, what will happen? It is like subsidiary and holding. On consolidation, both are one company or not?
Yes, sir.
In that case, what will happen? Intercompany owings will be cancelled. That's what in step number 7 we are going to discuss. Intercompany owings will be what? Cancelled. Correct? That means as per AS2, Ind AS2, inventory should be valued at cost or NRV, whichever is lower,
Yes, sir.
in order to secure conservatism concept. Correct?
Yes, sir.
Now, standalone subsidiary company's financial statement, it is correct. That is, I sold and made the profit of 50 rupees. 150 is my sale. Correct? And I made the
Yes.
profit. When I have merged, I will take this analysis of profits in that P&L, and in that P&L, I would have already taken that 50 rupees and I would have shared between non-controlling interest and holding company. I would have taken in my packet in step number 3 and 4 or not?
Yes, sir.
Correct. But now, in that inventory is there in holding company. Yes or no?
Yes, sir.
If that inventory would have been sold to outsiders, then it is realized profit. Unrealized profit will not come.
Okay.
Yeah, on the date of consolidation, suppose if such 100 rupee worth of goods which you have sold for 150, if that is laying in a closing stock, so what will happen? It is an unsold inventory, na?
Yes, sir.
So that means on that, so while merging, so what subsidiary has loaded that 50 rupees has not realized or not?
Not realized.
After
Yes, sir.
merging, after consolidating, so that CFS is nothing but it's a financial statement for holding company or not?
Yes, sir.
That holding company also Ind AS 2 will apply. So there also inventory should be valued at cost or NRV, whichever is lower. Correct?
Yes, sir.
So that means profit should be eliminated, then only you will get cost. That is, cost is 100, so NRV is whatever it might be. Since it is unsold, it also should be valued at 100 rupees only, no?
Yes, sir.
After merging, you are not different. I am is not different. Both are one. Therefore, if you made the profit, means between us, there should be monetary element. Got it? Yeah. So therefore, that element, if I have to remove, that's what we call it as unsold. That is, if the goods are supplied by subsidiary company, if remain unsold on the date of consolidation, then only unrealized profit will come. Correct?
Yes, sir.
That too, if a subsidiary company has made the profit, then only upstream. In that case only, because we are analyzing subsidiary company P&L. Therefore, now in step number 5, we are in non-controlling interest portion. Therefore, non-controlling interest portion profit we have to eliminate. Got it?
Yes, sir.
Yeah. So now balance what we get. So upstream and downstream, have you understood?
Yes, sir.
Yes, sir.
So now downstream means who has made the profit?
Holding company.
Correct?
Company.
So downstream means
Holding
profit
company.
made by holding company. That 100% we have to eliminate in step number 8. Got it?
Yes, sir.
Yes, sir.
Yeah. 100% we will eliminate where?
Step.
In step number 8. Yeah. So now here you will get what is the balance? What is the balance? Now here, my difference, along with this equity shareholders, there may be preferred shareholders also.
Yes, sir.
Correct? So therefore, what you have to do, add preference shareholders of subsidiary company, preference shareholders of subsidiary company. So here outside, what you have to add, outside, write it as outside preference shareholders. Sir, why outside preference shareholders? Holding company also might have invested in preference shares of subsidiary company.
Yes, sir.
Correct?
Yes, sir.
So that will be taken in a part of cost of control. So there it will go. So except holding company, outside others, because my category is what? Non-controlling interest. That means outside shareholders or not. So
Yes,
your
sir.
shareholders are equity shareholders and preference shareholders. Are you understanding?
Yes, sir.
Yeah. Both are outsiders only, not holding company. Are you understanding, Pramod, slowly?
Yes, sir.
So after adding subsidiary companies preferential right. So balance what you get. This is what we technically call it as so total non-controlling interest for CBS. Are you understanding, Pramod?
Yes, sir.
Yeah. So this is step number 5, non-controlling interest. So it is nothing but so share in capital plus share in reserves, capital profit, revenue reserve, and minus unrealized profit you will get on equity component on equity related shares. So what is the non-controlling interest? Then suppose if the company also had the preference shares, then outside preference shareholders we have to add here. Got it?
Yes, sir.
Yeah. So this is what step number 6. Step number
5.
step number 5. So very nice. Students are awake. Very good. Yeah. Yeah. So this is step number 5. So still another 3 steps are there. So that let us continue.